Hello, this is Kevin Prince from BMO ETFs. And today we're going to take the next 30 minutes and go over some market insights through our webinar as part of our overall series. I have a few guests with me today that I'll introduce in just a second. What we'd like to cover off today is give you some context, the market decades, as well as give you some focus on understanding different fixed income ETFs, give you insights to the market utilizing options, and then answer some questions and answers from last week's session. Again, I'll highlight to everybody listening to this session, going forward, if you want to have some questions answered, just simply send us an email responding to the survey today that you'll get at the end of this session, and let us know your questions for next week, and we'll do our best to answer those. We will be recording this session, and it will also be available in the future on YouTube. I will note one quick thing. The date for next week, we initially have posted it to be on the Friday of next week. We've actually kept the same time, but changed it for Thursday, and that'll be in the email that'll come out to the people who are participating today. Thank you for that, and let me get quickly started. You did see a couple of disclaimers that passed by. I'll quickly want to highlight the key points of disclaimers is that this is not really intended to be advice. This is supposed to be some insights to the overall market itself. Let me introduce my two guests who are going to join us today. Patrick Sinessa, he's from the TMX. He's one of the educators from the TMX himself, and he does a lot of education around options itself. Mark Reyes is the head of product at BMO ETFs. I asked both these individuals to come with us today and talk about some market insights. So with that, let's get going to the next slide there. And I want to give you some context to start off with about the markets itself. And this is just kind of taking a look at what has happened in the market for the last 30 years. We have certainly seen a lot of times where there's been some market turmoil the last 30 years. And what you're seeing through this chart is just showing you that over time, the market seems to get through these turmoil periods. Now, it does feel like something when you're in the middle of these turmoil periods, but you can see that over time, you're getting through it. Mark, just flip to the next slide there too. And let's show you some of the depths of the market. And just advance, next slide. You can see some of the depths the market went through during this period. Ultimately, if you look at some of the ones like the 2008 and 2007 period, you've seen some strong depths in that period. What you do know by looking at the other chart and getting context, you can see that there is potential for the market to advance from here and move forward. Maybe Mark, I can get some of your thoughts on this, and maybe Patrick too, if I can.
Sure. Thank you, Kevin, and thank you everyone for joining us today. One of the questions we've been getting in the last couple of weeks is this another 2008? Is this another massive sell-off that's about to occur? And it is quite different. Number one, there were some real structural things going on in 2008 through the mortgages, through the housing, which of course then infected financial services. And I remember the weekend that Lehman went under, and there was legitimate concerns on that Monday morning that the entire banking infrastructure was about to shut down. So that's quite different from where we are today, where the banks in particular actually have pretty strong balance sheets and will be able to weather some turmoil. Not to say that there isn't some significant short-term dislocation. I think this is the first time where something outside of finance is really causing the entire markets and economy to be suppressed like this. So it is unique that way, but it's certainly not the same as 2008. And how can I best illustrate that? Well, when markets really started going down mid-month, that Monday on, I believe it was the 12th, there was about a 10-day period where things were indeed looking very, very dark and gloomy. But then the Fed came in on the 23rd. We got some real support in the markets. U.S. government really pulled a 180 and is now announced flooding the market with support, the economy with support. And if you've seen markets come back up, yeah, there's been, of course, a lot of heightened volatility, and there has been further down days, but there's been a lot of up days to go with that. And if I even look at this week, the 1-2 punch has been, of course, the COVID-19 virus with the energy shock with Russia and Saudi Arabia going at it. But now we see that there's a bit of light at the end of the tunnel on the energy side. We get a quick pop on energy. At one point, it was up 40% in a day. It settled back down underneath that. But markets have certainly done a lot better than what we saw through 2008. So yes, heightened volatility. Yes, some legitimate concerns out there, including how long we'll be in this current shutdown scenario. But it is not really the same as 2008, and that's what the message I wanted to give people here. Thank you.
Thank you for that, Mark. And you know what I want to do is just keep it going here. I want to take some time and effort and talk about fixed income, because that's another aspect of course, investing out there. And maybe I can turn to you, Mark, around fixed income, and maybe give us a little background. We got a slide up here, kind of give us background and understand the overall fixed income market, because you can access these through different ETFs and mutual funds and individual bonds too. So maybe give us a little bit of background on that.
Sure. I mean, I can take it a fair ways back and say, yields in the last 10 years have certainly not been, our parents' bond market yields. And that's been an ongoing issue with fixed income investing, is really this ongoing search for yield, which now again, we see rates plummeting, at least on the short end, down to zero again. So we're right back in it. And that's really caused people to approach fixed income within their portfolios a bit differently, where, sometimes they've been reaching for yield by going into higher risk areas of the fixed income market. So in other words, stepping away from that, that Bank of Canada bond and buying some more differentiated paper, giving a higher yield, but having other risks. And I think we need to realize in a scenario like this, where equity markets are rattled, that carries through to credit markets. So the more credit exposure you have in your fixed income portfolio, the more it's been impacted. So government bonds being the more safe and secure, moving out to investment grade corporate, which just really means the companies with the better balance sheets, going out further to high yield bonds where they're more at risk of potential default and therefore pay higher yields. There's different points you can go within fixed income to find yield, but realize that it carries risk with it. So we've seen that in the last couple of weeks with ETFs, where the pricing has moved quite dramatically on some of these ETFs that have corporate bonds or high yield bonds, as a reflection of those credit spreads widening by over 100 basis points, or more than 1%. And that's been a dramatic shift. So I think it's important for investors to realize, why do they have fixed income in their portfolio? One, it's for offsetting equity risk over the long term. And second, it's to get some income off of that. So maintaining a defensive posture within fixed income, yes, you can be opportunistic with higher yielding asset classes, or you can hold weights in corporate bonds and things of that nature. But just realize the base purpose of fixed income in your portfolio, understand where your risks are, and then realize on top of that ETFs are what allow you to better access that than underlying bonds, because they are more liquid, because they trade on the exchange. I mean, one of the things we've seen is a gap between the market prices and the nightly net asset values, and people have wondered, is there something wrong with the ETFs? It's not that at all. It's that the ETFs have continued to trade while the underlying bond markets have been very stressed and illiquid. So again, for those that have needed liquidity, needed to sell, yes, you're paying a price for that, and that the market prices come down on those bond portfolios, but at the same time, you're still able to transact. So really, two overall messages there. One is understanding the purpose of fixed income in your portfolio, and two, realizing that the ETFs give you enhanced liquidity over those underlying direct bond buying. Thanks, Kevin.
Let's take a little bit more in fixed income, because you made a few good points there. Like, what's really going on in fixed income? What have people seen? A lot of changes in fixed income the last little while. And maybe you can take some time and talk to us a little bit about credit spreads, because that's an aspect, the yield curve, of course, and then of course what's individually going on with inside the ETF around liquidity you just mentioned.
Sure. And I think, when people look at the price action on fixed income over the last month, they've been surprised, because they would have expected equities were going down so dramatically that you would have thought that fixed income would have been rising to offset that. And again, it depends where you are in fixed income. So the first chart that we show there, is our aggregate bond, which has, about 70% government bonds in it and about 30% corporate bonds. And it's really those corporate bonds where the spreads widen that cause the price to fall. So what is a credit spread? It's simply the additional yield that has to be paid to reflect the risk of the issuing company compared to a government. So, you can imagine that a major Canadian bank has some credit risk, but not as much as, let's say, something in the oil patch or a smaller cap name where they might carry more, or a company that's essentially highly indebted would have a higher credit spread. So it's that credit component that actually caused the prices to move out, whereas the yields have been fairly consistent. And that's why I gave the 2 second charts, one to show that credit spreads have essentially moved up from less
Maybe we
than
can advance
2.
that second chart there. Let's just advance that second chart if we can. The one on credit spreads. That's a good one. Thanks for that.
Okay, sure. So that is a great illustration, and it goes back to 2008 to show you how credit spreads have widened, not to the degree of 2008, but they have widened. And then we overlaid it with the VIX index, and the VIX essentially is what we call the fear index, which essentially measures, investors' view on the marketplace and sentiment. Certainly, Patrick will tell us a lot more with options, but the VIX does give us a good glance at that. So within fixed income, the interest rate or exposure to government bonds hasn't shifted that much. It's been the corporate bonds that have been driving some of that price differential, which then started to really close back in over the end of the month after the Fed announcement.
And maybe we can advance the next slide there, because I think what you've prepared for us is interesting, is that you've taken more of a historical look too, because it's always good to know what, give us some reference to history. Is this something that's happened in the past, and what does it mean relative to the past? So maybe Mark, you can talk to that too.
Sure. Well, we just picked a couple of major U.S. ETFs. J&K is a high yield bond ETF, and LQD is an investment grade bond ETF, which both two of the biggest ETFs in the U.S. that have been around since pre-2008. So again, because we're getting a lot of 2008 questions, it's a nice comparison here. So what you see, rich cheap, which is also known as premium discount, or the difference between a market price and the net asset value at the end of the day, you do see a lot more noise in that during these stress periods. But I'll point out again that it doesn't imply that there's a market price issue with the ETF. It actually means the underlying bonds are not trading, and therefore the NAV itself is not, shall we say, fully up to date with market conditions. The ETF, which keeps trading on the exchange as you and I buy and sell it, that's the true indication, the market price of the value of that basket at that point in time. So during periods of heightened volatility, we should expect to see more rich cheap in these ETFs, but it actually means the ETFs are providing price discovery as opposed to an issue with the market price.
Thanks for that there, Mark. I appreciate the historical context too. I'm going to turn to Patrick here, because, as we look at fixed income ETFs, there's also, like we had last week, we can take a look at various options on fixed income ETFs. And you've put together a list of various fixed income ETFs out here in the marketplace, from either a broad market or a high yield, like Mark talked a few minutes ago, or iShares and whole works. Maybe you want to talk to that briefly there, Patrick.
Right, Kevin, and you're welcome to help me out in explaining there. But like Mark was just talking about, he was referencing the LQD and the JNK, which in the U.S. represent the high yield corporate bonds and the investment grade corporate bonds. And really the way you want to divide it, and it's, for a lot of beginners, it's overwhelming. They see all these different bond indexes, and well, they can usually understand stocks and the different sectors within stocks, but it's harder for a lot of retail investors to visualize the different parts of the bond markets. But really you want to divide it, that there's government bonds and then there's corporate bonds, and the corporate bonds are then divided into investment grade, which are rated high quality, and then the high yield bond market or junk bond market, which is increased risk of defaults or restructurings and other things that rate the companies at a lower rate. And so there's different ETFs that basket these bonds in different groupings. And so we on the Montreal Exchange, there are a series of these ETFs that have options available to them. And we're going to talk about that. But Kev, maybe you could quickly talk us through how these, what the composition of these are.
I mean, I think the first one is the one key is because that's kind of a broad market fixed income where it's got not only the corporates, but the governments and the provincials within inside that. High yield being a little more of the more the kind of nickname junk bonds out there, the higher risk bonds. Corporate bonds, straightforward, as simple as that. Short term tends to be a mix of, again, corporates, provincials, and governments there. And that gives you kind of a snapshot. You can clearly see the titles there right across the board. Maybe we'll advance to the next slide there.
And I'll just actually, Kev, what I'll just want to add to that very quickly is just when the word short term versus some of the longer duration bond mixes, the shorter term ones have substantially less volatility. So if one is actually, it's just convexity, I guess, of what longer duration bonds have. And so when people are wanting to lower the volatility of their portfolios, moving towards the short term bonds has less volatility.
Well said. Well said. Now, can you give us some insights, because you did like the last week, what is the options market telling us about the direction of the bond market and keeping your percentages in there? Yeah.
Right. And so really what we wanted to do is just, there was a substantial credit event that occurred in that crash. And that's why both the Bank of Canada and the Federal Reserve came in with just a historical they were provided huge liquidity with these new QE programs, and that's really meant to stabilize the credit markets. And so we had this incredibly volatile event where many of these dropped very rapidly and then recovered just as rapidly the moment the central banks stepped in. And so even though we saw, even just in March, the BMO aggregate bond ETF trade as low as $14, the options market now is actually finding a new higher level for these probabilities. For instance, right now, the options market is assigning only a 10% probability that we would revisit between now and June those lows that were established here in March. And so even though we all saw it trade down there, the options market, at least at this moment, is not giving a very high probability of that. It's much more likely that we're going to gravitate towards the trade range that was already established throughout 2019. And even just a modest dip, let's say down to the $15 level, the option market is pricing at only about a 25% chance at this point.
That's interesting. What about a little bit further out? What do you see there?
Right, and so just stretching it out, the options market is still, it's a very much the same kind of mix. You can, now we switch to a weekly chart, so now you can see zoomed out all the way to 2017, and what we can really see is like that $14 level down below where we saw that very short-term credit event drive. It's still only for the rest of the year giving it only about a 20% chance of revisiting that level. It doesn't show it on the chart because the weekly chart didn't capture that intra-week drop down there that occurred. But the key takeaway is that on balance of probabilities, the option market continues to show that there will be some bond stability, and that's a good way to consider diversifying your portfolios, is maintaining those bonds that will keep that income stream coming in. And even though it was a very noisy ride in March, the options market is not assigning a lot of risk to another downwards move in bonds yet.
That's very insightful. Thank you for that. Now we got some questions coming in from our previous webinar, and effectively the first one is as the S&P kind of stabilized a bit, and do you anticipate the worst is over? Maybe I'll keep it with you, Patrick.
Sure. In bear markets, whenever there's a big crash of any magnitude, then from a reflexivity perspective, some of the biggest up days that are recorded are always days that follow a previous down day. And it's just an interesting quantitative stat that you can look up when you historically look at that. And so we had this reflexive rally off of the lowest levels. The market crash that we saw really priced in the shock of the fact that we may see in the tune of 25 to 35% transitory drop in QE, sorry, not QE, in the GDP of the economy, just because when you basically keep everyone home, the economy just stalls. And that's it. But the question, of course, that we're trying to figure out is the economy easily restarted once all of these self-isolation things that we're doing end? And one of the things that I would look at here is that while we're stabilizing, I think the market has now priced in this. What is not potentially priced in, and that's where the risk is into the second half of the year, is that what are the knock-on effects of this of us shutting down the economy the way we did to fight the coronavirus? And I don't know whether I'm brave enough to make a too bold of a call, but whether or not the S&P 500 here stabilizes at 2,600 is really a lot about what emerges as the after effect of the fact that this has now been the coronavirus has been priced in.
No, that's that's good considerations, and just everybody's got to think about those things through. Let's take a look here too. There's kind of that constant question we get in from time to time around selling, going to the marketplace. Mark, maybe I can go to you because somebody else is looking at, going to cash if it drops further and really maybe buying back in the future. Maybe you can give some thoughts around that. We talked a bit about last week, but maybe you can refresh the thoughts around that again.
Sure. Thanks, Kevin. Well, number one, I think it's never an easy decision, but to sort of capitulate at a point when markets are at a low is typically a point where a retail investor tends to not come out ahead. Sort of the opposite, right? If you're talking about selling low, buying high, that's always the danger when you go all the way to cash. So it's always a personal decision and depends on your risk appetite or risk limits. If I just use the month as an example and what's happened since we talked last week, we didn't really expect that quick of an announcement on the oil issue. We've already got the Saudis and Russia starting to chime in now, and that's been very positive for the market. Whereas, only a few days ago, I don't think anyone thought that was coming right away. Certainly, there was pressure. So it's very difficult to go all the way to cash because then you're going to run into the psychology of eventually buying in as the market's rising. And missing out on some of that return. So putting some element of the portfolio in cash and at a heightened level when we have this volatility certainly makes sense. What that allows you to do is continue to buy on the dips. We're seeing a lot of that activity now. So when you think about those aftershocks that are occurring in the marketplace, days up, days down, doing some trading on there makes sense. But if we look ahead and we think COVID-19, there's discussions now of waves of it, particularly when economies start to open back up. What is that going to mean? That could have further implications for markets up and down. And as well, once we get into the earnings cycle, not just this quarter, but next quarter, because I think this quarter you're only going to see a partial impact of things like the banks of depressed earnings, but the quarter away, that's when you're going to see the full impact. And so depending on what people's view on the virus is at that point in time, that's going to color how they view the earnings that come out. And so that's going to create volatility up or down again in the market. So there is opportunity, but I just think going all the way to cash does carry its own unique risks and makes it very difficult if markets start to rise for clients to come back in.
No, that's very insightful and good way of looking at the market for people out there. There is a lot of questions going out there about gold right now. It mentions a BMO ETF because it's a BMO ETF webinar. Feel free to talk beyond that too. But ultimately, can you give some suggestions out there of what does gold do in a portfolio, and maybe talk to that before specifically talking about parking money in a gold. Maybe Mark, you can talk to that.
Sure. Well, gold is a valued tool for an investment portfolio because it doesn't act like equities and it doesn't act like bonds, so it helps to diversify your portfolio. And as a hard asset, as a commodity, if we get into this period now again of QE and printing money, and if the value of tangible things starts to rise, gold will be one of the benefits of it. We are certainly hearing a lot of interest on the street in having an allocation of gold in the portfolio. One, it takes away from some of your equity risk, but two, if gold has an opportunity to rise with this money sloshing around, it certainly could have a significant rise. So I'm not going to try to call the level of gold. However, similar to coming out of 2008, there is a real opportunity with all the QE to have a portion of your portfolio in gold. And what's interesting about gold as a commodity has been rising, and we've seen that. But gold equities have been sort of suffering with the general equity fall. So there is an opportunity with the gold producing companies to invest that way as well. So BMO does have an ETF, ZGD, which is an equal weight gold producers company ETF as opposed to gold bullion, which is an interesting way to play this trade. And there are, of course, other gold bullion ETFs out there. So an allocation of gold at this point certainly is prudent. And if we do get a level of inflation via QE down the road, that'll be beneficial to gold.
Thanks for that. Let's take a look at the next question here coming in from last week. We just advance the next slide. And if we could just advance the next slide there. Oh, hey, you know what? Actually, this is good from Patrick, because Patrick, maybe we'll spend some more time talking about cover call in the futures, but maybe give I certainly get a lot of questions in on cover calls. But I guess, two things. Can you talk about cover calls at a high level? And then specifically, can you do those on fixed income into themselves? And maybe you can speak towards that, just to keep it to the same topic.
Well, for sure. And, BMO has a number of option writing ETFs where one of the really neat parts about options in general is they can be used to enhance income. And while one can buy an ETF that does it internally within it as an asset class to diversify your portfolio, you can also, as an investor, choose to directly do the covered call writing on the ETFs that you own. And so the act of covered call writing is taking something that you already own. So you already own the shares, whether it's an ETF like in equity or an ETF in bonds, you own it, and then you sell a call and earn a premium for giving someone the right to buy that bond ETF, in this case, away from you at a specific price over a specific period of time. Best way to always look at it is with an example. So if we advance to the next slide, what I'm showing here, if you click it one more time, so the middle bar appears in the middle here, but there you go. And so what we have, let's say as an example, that BMO Aggregate Bond Index ETF, the ZAG. Let's say an investor owned 1,000 shares of it and had $15,000 of this in their portfolio. That is paying right now a 4-cent monthly distribution, which is annualizing at around a 3% income yield coming from that bond ETF. Now, one could just own it, but if you were looking at it purely from an income perspective and said, I don't really care much for the appreciation of this aggregate bond ETF, I'd rather just get a consistent income stream, one can turn around and sell for this example, a September 2020 $15.80 strike covered call, which is essentially what we call at the money, but I'm not going to get into complexity. What I want you to take away is that for 169 days, just a little less than half of a year, you could turn around and, let's say, have collected $450 of income premium, or 45 cents per share. What this has done is essentially you forfeited the upside potential appreciation for a fixed income that is earned as real as a dividend. So in this situation, that 45-cent premium with the 24 cents of interest income you'd earn over 6 months, you're turning around and earning just over 4% in 6 months, or an annualized rate almost near 9%, without needing the bond ETF to go up. And so it's just a way of actually diversifying your portfolio and making not needing your portfolio to need appreciation to make money. Even if the thing stayed the same, you can turn around and be harvesting what most people would consider a very reasonable income.
That's pretty interesting. I think what we're going to do in the future is spend a little bit more time on one of these webinars in around cover calls and cover call writing. But in the meantime, I'm sure you maybe want to highlight where you can get more information right now on that, Patrick.
Oh, for sure. Anyone who wants to watch the videos on that or learn more about it, there's all sorts of options training courses available at the Montreal Exchange. Right now, Options Play has a master's course running through the Montreal Exchange. All of that information is available. If you just go to the Montreal Exchange and go to their education tab, and you can, there's all sorts of amazing tools to learn about this.
Thank you for that. And that's all the time we have for today's session. We're going to be back next week. This time, again, one more reminder, on Thursday of next week. Same time as today, but just Thursday. I encourage everybody to send your questions in, because that forms the basis of these webinars. We're really trying to help you navigate the market through these times and provide the insights you need to really make informed decisions out there. Thank you so much for your time today. Have yourself a good weekend. Cheers.